If you're a Forex trader, you need to master market analysis. It's the cornerstone of making informed trading decisions and maximizing your profits. Let's uncover the secrets today. Understanding these concepts can give you a significant edge in the market. First, understand the basics, supply and demand. This fundamental principle drives the Forex market. When more people want a currency, its value goes up. Conversely, if demand drops, so does the currency's value. Next, look at economic indicators like GDP, inflation, and employment rates. These are crucial for gauging the health of an economy. These tell you how strong an economy is. A strong economy usually means a stronger currency, while a weak economy can lead to a weaker currency. Don't forget technical analysis. This is another essential tool in your trading arsenal. This is where you study price charts and patterns. By analyzing historical data, you can predict future price movements. Look for trends and signals like support and resistance levels. These can help you identify potential entry and exit points. Stay updated with news. Political events, natural disasters, and even tweets can shake the market. News can cause sudden and significant price movements. Social media platforms can also influence market sentiment, so keep an eye on trending topics. Lastly, practice good risk management. This is vital for long-term success. Always set stop-loss orders to protect your investments. This helps you limit potential losses and manage your risk effectively. Consistent risk management can make the difference between a successful trader and a struggling one. So there you have it. With these strategies, you're well on your way to becoming a proficient Forex trader. With these tools, you can analyze the Forex market like a pro. Remember, continuous learning and practice are key. Ready to dive in? Let's get started. The Forex market awaits your expertise. In this section, we will dive deeper into the technical analysis of the Forex market, exploring various indicators and tools used by traders to predict market movements. Stay tuned as we break down complex concepts into easy-to-understand segments. First, let's talk about moving averages. Moving averages smooth out price data to create a single flowing line, which helps you identify the direction of the trend. The most commonly used are the simple moving average, SMA, and the exponential moving average, EMA. The SMA is calculated by averaging a set number of past prices, giving you an idea of the average price over a specific period. The EMA, on the other hand, gives more weight to recent prices, making it more responsive to new information. Next, we have the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements and is used to identify overbought or oversold conditions in a market. An RSI above 70 typically indicates that a currency is overbought, while an RSI below 30 suggests it is oversold. This can help you decide when to enter or exit a trade. Another essential tool is the Fibonacci retracement. This tool is based on the idea that markets will retrace a predictable portion of a move, after which they will continue to move in the original direction. By drawing Fibonacci levels on your chart, you can identify potential support and resistance levels, helping you make more informed trading decisions. Don't forget about Bollinger Bands. These consist of a middle band, which is a simple moving average, and two outer bands that are standard deviations away from the middle band. Bollinger Bands help you understand volatility and identify potential breakout or breakdown points. Finally, let's discuss candlestick patterns. Candlestick charts provide more information than simple line charts, including the open, high, low, and close prices for a given period. By studying various candlestick patterns, such as the doji, hammer, and engulfing patterns, you can gain insights into market sentiment and potential price reversals. So, there you have it. With these technical analysis tools, you're equipped to dive deeper into the Forex market and make more informed trading decisions. Remember, practice and continuous learning are key to mastering these techniques. Ready to take your trading to the next level? Let's continue our journey. Now let's move on to fundamental analysis. We'll discuss how economic indicators, news events, and geopolitical factors influence the Forex market. By the end of this chapter, you'll have a solid understanding of how to incorporate fundamental analysis into your trading strategy. First, let's talk about economic indicators. These are statistics about economic activities that provide insight into the economic health of a country. Key indicators include gross domestic product, GDP, unemployment rates, and inflation. For instance, a higher GDP indicates a growing economy, which can strengthen the country's currency. Conversely, high unemployment rates may weaken it. Next, we have news events. Major announcements, such as changes in interest rates by central banks, can have significant impacts on currency values. For example, when the Federal Reserve announces an interest rate hike, the US dollar often strengthens as investors seek higher returns. Staying updated with economic calendars and news feeds can help you anticipate these movements. Geopolitical factors also play a crucial role. Political stability, government policies, and international relations can affect investor confidence in currency values. For instance, political unrest or trade tensions can lead to currency depreciation. Understanding the geopolitical landscape can give you an edge in predicting market trends. Another important aspect is market sentiment. This is the overall attitude of investors towards the market or a particular currency. Sentiment analysis can be done by monitoring social media, news headlines, and financial reports. Positive sentiment usually leads to currency appreciation, while negative sentiment can cause depreciation. Lastly, let's not forget about the impact of natural disasters and pandemics. These unforeseen events can disrupt economies and cause significant market volatility. For instance, the COVID-19 pandemic led to unprecedented market movements, highlighting the importance of being adaptable and responsive to such events. By combining fundamental analysis with technical analysis, you can create a more comprehensive trading strategy. Remember, the Forex market is influenced by a multitude of factors, and staying informed is key to making successful trades. So, are you ready to incorporate fundamental analysis into your trading arsenal? Let's continue our journey and explore more advanced techniques in the next chapter. Finally, we'll wrap up with some practical tips and strategies for Forex trading. We'll cover risk management, trading psychology, and how to develop a trading plan. These insights will help you become a more confident and successful trader. First up is risk management. One of the most critical aspects of trading is protecting your capital. Always set stop-loss orders to limit your potential losses on any trade. Never risk more than a small percentage of your trading account on a single trade. This is usually recommended to be around 1 to 2%. Next, let's talk about trading psychology. Keeping your emotions in check is vital. Fear and greed are two of the biggest enemies of a trader. Develop the discipline to stick to your trading plan and avoid impulsive decisions. Practice mindfulness techniques to stay calm and focused during trading sessions. Remember, trading is a marathon, not a sprint. Now, on to developing a trading plan. A well-structured trading plan acts as your roadmap to success. It should outline your trading goals, risk tolerance, strategies, and rules for entering and exiting trades. Regularly review and adjust your plan based on your performance and market conditions. Consistency is key. Another crucial tip is to keep a trading journal. Documenting your trades, including the reasons behind them and the outcomes, helps you learn from your mistakes and successes. Over time, this practice can significantly improve your trading skills. Lastly, continuous education is essential. The Forex market is dynamic, and staying updated with the latest trends, strategies, and tools is crucial. Join trading communities, attend webinars, and read books to expand your knowledge and skills. By incorporating these practical tips and strategies into your trading routine, you'll be better equipped to navigate the complexities of the Forex market. Remember, patience, discipline, and continuous learning are the pillars of successful trading. Thank you for joining us on this journey to mastering Forex trading. Stay tuned for more in-depth content and advanced techniques in our future videos. Until next time, happy trading!